Good afternoon. Peter Klein, Chief Investment Officer, co-founder, ALINE Wealth. With you this afternoon on the 25th of March, 2025, for our March conditions briefing. I would go through some series of slides with you, and then I want to speak with you about how we do what we do at ALINE. So I think that will be of some interest. So allow us to get started. Okay, let us start with our take. Where do we see the investment conditions? As we've been saying for almost 4 years now, a regime change. After 40 years of the markets that have been buoyed by ever lower interest rates, the cost of money, which has provided a beautiful wind at the backs of investors and speculators and consumers. When the price of money goes down for 40 years consecutively, all good things happen to investors. Inflation was slayed, and that was the macroeconomic backdrop that allowed for this ever lower interest rate environment for 40 years. And inflation was slayed through a confluence of events which are unlikely to repeat themselves: globalization, collapse of the USSR, and the flood of commodities onto the market, which depressed. These are all disinflationary circumstances. Technology, of course, immigration. We have the opposite in many of these situations today. And of course, the byproduct of this run of disinflation for 40 years and lower interest rates, multiple expansion, increased risk taking, the Fed put anything goes wrong, we'll just cut interest rates because we can. This is the mentality, right? There wasn't inflation. So that was the way, that was the toolbox that was used by multiple Fed chiefs over the course of the last 4 decades. But we believe that things have changed. And this is a great little chart that shows you the side by side that we're talking about here: free markets and deregulation, I should say, not e-regulation, compared with where we are today, where we have climate change and decarbonization, where we have a more of a reshoring and nearshoring versus a globalized labor supply and the arbitrage of opportunities to lower prices. And so these are the differences between the two, we'll call them regimes. I think this graph really sums it up, right? Because from 45 to 82, we had this increasing interest rate environment. And look at the CAGR for the S&P 500. For those, it's compounded annual growth rate. So the S&P had grew at about 5.7% over that period of time, 36 years, because interest rates were going up, and that's a a headwind to valuations and a headwind to growth. Now, couple that with the right side of the graph, and you will see a decreasing. This is the greatest bull market in bonds we've ever seen, going from roughly 16% in 82 to zero in 2020, 39 years, and a CAGR that was double that. So obviously, this is the wind at your back, right? Look at the last piece right here. You see the difference, right? And this is as of 23, so you can see it even a little bit higher, perhaps here, well, right about here, I guess. So, this is the kind of thinking that we're having right now, where that we're likely to embark upon a period of time where interest rates, let's just call them normalized. So to sum it up, the wind is no longer at investors' back. Therefore, we need to be more active, more engaged, know what you own and why, do the fundamental research, the stuff that we do day in after day here at ALINE Wealth. Things are changing, as I said earlier: deglobalization, nearshoring, labor strength, the decarb standards, and of course, the deficit and debt spending. So we think more value-oriented, more fundamental analysis, more resource-based companies. We were very early on this inflationary call, this call of more international, of more resource, more precious metals, more commodity. And it's worked fairly well. And again, cautious on bonds. We like to overweight cash. We respect the volatility. we use cash as not just as an optionality, value where you could use to put it to work when opportunities avail themselves, but also as a ballast to overall portfolio mix. So, so we respect cash, and now we're getting paid to hold cash. We don't believe fixed income is the ballast it once was, so we're suggesting be cautious, at least for intermediate to long-term fixed income. Dividend growth and value style, investing in companies with high free cash flow yields. This is where we think there are opportunities, as well as in the inflation-centric sectors like real assets and infrastructure and resource companies. Of course, the water sector, we always speak about that, and it's been a wonderful place to invest for our clients for years now. I wanted to share this slide with you because I think it speaks to the circumstance with respect to deficit and debt. This is we're talking about here the interest expense, about $1 trillion going forward each year, and the expectation, as you see here, for 2025, 24. So far, it's only year to date. It's 478 billion. Last year, it topped almost $1 trillion. That's equal to our military spending, by the way. And as you could expect, given that this interest rate is, on average, lower than what we're seeing on paper today, it likely might not come down over the next couple of years as we work off a low interest rates paper, and now we're getting higher interest rate costs for this $38 trillion of debt. This is the slide that really sort of puts it in perspective, the regime factor. Look at the CPI back here. This is, of course, in the 70s and early 80s. This is when interest rates were very, very high. And then look at this sort of period here where inflation just stayed super low. And that gave the opportunity for higher and higher margins and lower interest rates. And here's what we could see for the last couple of years. This is when inflation peaked in 22. It's come down from there a bit. We do subscribe to the theory of a second wave. There's a strong historical precedent for it. And, it's not terrible. It's just that this is sort of how we see the macroeconomic sort of tea leaves going forward for the reasons that we've enumerated, that inflation is not going to go away so quickly. And by that means, interest rates won't come down so quickly. This is a slide I want to make sure we talked about because it's firmly in the space of what we do as investment advisors. And what I mean by that is margin debt is what investors typically, individual investors, retail investors, folks that we work with, and it could be a very risky situation when you have a lot of margin debt in a portfolio and the portfolio's values go down. Here we're showing that there is despite the cost of margin debt now, it's no longer very low where it was a few years ago. Now the interest rates are higher, so the margin costs are higher. And despite that, we're at new records, or at least 2021 record levels. That had me, I was surprised by that. And it gives me pause that everybody's sort of very bullish and, dare I say, frothy in their concerns about, or their expectations about the future of equities going forward. So this worries me because when we're seeing everybody, like Buffett always likes to say, you want to be very careful when everybody's very bullish, and you want to be very bullish when everybody's scared. And this sort of speaks to that. I'm going to throw out our contact information. I'm going to stop the share here for a second and talk with you a bit about how we do what we do. And this is important because we never really speak about that, right? We often on these videos, I talk with you about the markets and the conditions and what how we navigate those and what we're thinking about market-wise. But we don't speak enough about our MO. Modus operandi, to sound fancy. So clients trust us to allocate their investment capital through the capital markets maze, right? To understand their risk tolerances, their objectives, to have a grasp on their cash flow, their liquidity needs, any tax issues, any unique circumstances. So imagine this is a dual mission, right? We have to know the markets and know where we are, how to analyze the markets globally and analyze companies and investments. And in the same token, we have to understand our clients and their issues. So, and that allows us to be a wealth manager, right? That separates a wealth manager function from, say, the hedge fund manager or the portfolio manager. They're not talking, they're not involved in the dual mission, right? All they care about is the investing side. They don't necessarily care about, the individual investor's needs and objectives. That's where we come in. So we have to balance those two missions, the duality of those, and understand our specific client and their specific needs and issues. Okay. So we are not just investors, but we're also stewards, right? We care. And therefore, we have to balance these two circumstances, as I just said. And it's also a dynamic balancing methodology, right? Things change. Things change in the lives of our clients. So we have to always listen and ask the questions to determine if anything material has changed with them so that we can alter what their objectives or constraints might be. And so we call this proactive empathy, being proactively caring about our clients. Okay, so now that we have, now back to that MO, right? That how do we do what we do as it relates to the investing function? And how do we do it on the behalf of our clients to grow their asset base? So in preparing for this talk, I came up with a metaphor. Now, forgive me. Forgive me in advance, but humor me. Our investing function is like a personal shopper, okay? Knowing what works for our clients, taking their measurements, understanding their style preferences, their fit. And then you go out to the marketplace. I hope you're getting my point here. And then you go out to the marketplace every day and seek the best opportunities that fit those clients. That hopefully gives you a good sense of what we do and how we do it. Now, this is why we embrace a balanced portfolio approach, especially today as risk-free assets, good old cash, is yielding something material, whereas a few years ago it was zero, making this function a lot more difficult. So with a balanced portfolio, we can use the market's volatility. Markets move every day. Much of it is noise, by the way, but it can also provide us with an opportunity to buy with the dry powder, the cash that we've positioned, or in some cases using volatility when markets go hyper to the upside to sell and add to cash. And we do this around the edges, right? It's not a major moves. It's tweaking, and we do this periodically and systematically. This is why we do not subscribe to the all-in or all-out mentality. It's too close to speculation. Better to be balanced and active and always fiduciarily centric. Now, as I just said, sometimes we're sellers and sometimes we're buyers, but we are always active and always solidified in our mantra at ALINE, always putting clients first and second and third. Now, finally, there's the work that we do on the planning side. Navigating the markets effectively over the long term is a critical part of what we do. But there's also the planning part for our clients and their heirs and their legacy. It's a critical part of what we do at ALINE: financial planning, cash flow planning, estate planning, legacy planning. All of this is the work that we help our clients with others, with other team members, be it accountants or attorneys, to make sure that it's a complete wealth management experience excellence at every turn. So I hope this helps frame what we do at ALINE for our clients, and we welcome the opportunity to do it for you and continuing it doing for our clients. We're here to serve, here to help you navigate these waters. So feel free to give us a call. Let us help you and discuss your portfolio and how we may be able to work with your planning, with your plan. Thank you for your attention. Have a great week.